Just a short time ago, big banks said gold might rise later in the year. Now prices are racing toward those same targets early. When that happens, the same experts often go quiet or warn people to slow down. That's why it's better to watch actions, not words. Now let's talk about the physical market. This is where most online analysis fails. Spot price is just a number on a screen. Physical metal is a real supply chain. It involves inventory, production limits, shipping delays, and risk management. When demand jumps, premiums rise first, then popular products sell out, then back orders appear. Eventually, buyers ask a simple question: what can I actually get today? Many people assume markets are always liquid. In real stress, that assumption breaks. When you hear about long lines at trade shows or dealers overwhelmed with buyers, that's not a fun story. It's a warning sign. People are moving from watching to acting. They don't have to be right, they just have to act together. Sometimes mints pause sales or adjust prices. That's not always incompetence. If prices move too fast, selling at old prices would drain all inventory instantly. Pauses tell us the system is under stress, and stress feeds more demand because people fear scarcity. Here's an important lesson. Don't wait for the perfect price. Stick to a plan. Waiting for perfection in a changing market often means missing the move. Yes, there will be pullbacks, but pullbacks in strong markets are short. In weak markets, they drag on. Know the difference. Why could this continue? Because early moves are driven by informed buyers. Big moves are driven by the crowd. And crowds act emotionally. The trigger could be anything: a failed Treasury auction, a surprise policy change, a bank admitting losses, or a geopolitical shock. You won't see it coming clearly. You'll only recognize it after it happens. So don't focus on predicting the spark. Focus on the fuel. The fuel is everywhere. Too much debt, too much leverage, too much confidence that central banks can fix everything. This isn't about hoping for chaos. It's about protection. The system already asks you to accept silent losses. Your money buys less each year. Your work is worth less. That's why people are turning to wealth preservation. In simple terms, gold and silver are not just bets on price. They are a way to avoid relying on promises. When enough people refuse those promises, prices adjust. It's early 2026, and instead of a slow buildup, we jumped straight into fast action. Silver went from interesting to hard to ignore very quickly. Speed matters because markets move on psychology. Fast moves grab attention. Attention brings new buyers. This demand isn't just paper trading, it's physical buying. People want metal in their hands. Savers don't flip trades, they hold. That metal leaves circulation, tightening supply. When supply tightens, it disappears in stages. Cheap options go first, then popular ones, then fast delivery. By the time the public realizes what's happening, the market is thin. And thin markets move violently. Now let's talk about the pressure points. First, debt. Debt now feeds itself. Interest creates more borrowing, which creates more interest. This doesn't need to reach infinity. Confidence just needs to crack. Second, Treasury market stress. Weak demand for government debt is not normal. Treasuries are the foundation of the financial system. If they wobble, everything feels it. Third, commercial real estate. Many loans were made in a different world. Refinancing at higher rates is exposing problems. The danger isn't just buildings, but all the financial connections tied to them. Fourth, global moves away from the dollar. The dollar won't vanish overnight, but more trade is happening outside it. Gold is playing a bigger role in settlement and trust. Fifth, control responses. Digital money systems, tighter monitoring, and new rules don't appear when systems are healthy. They appear when stress is expected. These pressures don't hit alone. They stack. And when they stack, confidence slips. Now about inflation. You're told it's under control, but your grocery bill says otherwise. Stable inflation just means prices rise more slowly. It doesn't mean they fall. Purchasing power keeps shrinking. Gold and silver don't need runaway inflation. They rise when trust in money weakens. The Federal Reserve is stuck. High rates expose debt problems. Low rates weaken the currency. Either way, savers lose unless they own assets that can't be printed. If the dollar's dominance fades even slightly, excess dollars come home and chase limited goods. That means higher prices in daily life. Gold and silver are signals. They reflect trust, or lack of it. Trust in institutions, media, governments, and currencies is falling. That's why collateral matters. That's why central banks quietly hold gold. This doesn't mean a return to the old gold standard. It means gold acting as a confidence anchor behind the scenes. For everyday people, the lesson is simple. Don't obsess over price. Understand physical demand. Have a clear plan. Build positions calmly, not emotionally. Paper assets depend on rules. Physical assets don't need permission. The next big move may start quietly. A pension shift. A foreign seller, a routine filing. By the time it's obvious, prices will already have moved. This isn't a single reset day. It's a slow process with sudden bursts. Gold and silver are not magic, but they are real. Final thought, transitions are messy. Ignore the noise. Watch the system's direction. More debt, more control, more currency dilution. If you're watching now, you're early. Stay disciplined, stay patient, watch the pressure points. And remember, when the public rush begins, it doesn't announce itself. It hits like a wave.